Picture this. You're scrolling through your 401k statement on a quiet Sunday morning, coffee in hand. The numbers look good. Better than good, actually. Your portfolio is up double digits over the past couple years, and you're feeling pretty smart about your set it and forget it strategy. Then you open up the news, and there's another headline about artificial intelligence, about how the AI boom is changing everything. And you think to yourself, yeah, that tracks. That's probably why my portfolio has been doing so well. Everyone's winning with AI. But here's the thing nobody's talking about at your office or at dinner parties. Those gains you're celebrating, they might not be what you think they are. And more importantly, the portfolio you believe is diversified across 500 American companies might actually be a concentrated bet on a handful of technology firms that are spending hundreds of billions of dollars on a technology that, according to research from MIT, is failing to deliver returns for 95% of the businesses trying to use it. And if that doesn't make you sit up a little straighter, consider this. In October of this year, something remarkable happened. Within the span of a few weeks, major financial institutions around the world started saying the same thing almost simultaneously. The International Monetary Fund mentioned echoes of the late 90s dot-com bubble. Goldman Sachs released a report literally titled, AI, in a bubble? And their CEO publicly warned of a potential market drawdown within the next 12 to 24 months. When the people whose job it is to stay calm about markets start using the word bubble in the same sentence as the thing driving your retirement account higher, that's worth paying attention to. I'm James, and I spend a lot of time thinking about money and financial psychology, specifically how regular people like you and me can build real long-term security without getting swept up in the hype cycles that seem to crash every decade or so. If this video helps you think about your money differently, I'd really appreciate it if you hit that subscribe button and gave this a like. It helps more people find this content, and honestly, this is information I wish someone had shared with me years ago. Let me start by addressing what most people believe about AI investing right now. The common narrative goes something like this. AI is the most transformative technology since the internet. The companies leading the charge are some of the most profitable businesses in history. Unlike the dot-com companies that had no revenue, today's tech giants are making real money hand over fist. And if you just stay invested, the long-term trajectory is up and to the right. Now, some of that is true, but it's also incomplete in ways that could really hurt your financial future if you're not careful. Here's reality check number 1. According to data from major financial institutions, tech stocks now make up approximately 36% of the S&P 500. That's actually higher than the 33% concentration we saw at the peak of the dot-com bubble in 2000. The top 10 stocks in the index represent nearly 40% of its total value. To put that in perspective, the historical average is somewhere around 20 to 25%. We are at levels of concentration not seen in 50 years. Reality check number 2. Research published by MIT's NANDA initiative this year found that 95% of companies investing in generative AI are seeing zero measurable return on those investments. Let me say that again, 95%. American businesses have collectively poured between $30 and $40 billion into AI projects, and the overwhelming majority are getting nothing back. The tools don't fit into existing workflows, they don't learn from feedback, and companies are spending most of their AI budgets on marketing and sales when the real ROI, according to the research, is in boring back-office automation. Reality check number 3. Many of the AI startups commanding billion-dollar valuations are losing money at staggering rates. OpenAI, perhaps the most famous AI company in the world, is reportedly on track to lose billions of dollars this year alone. They're not expected to break even until 2029, if ever. Yet the hype keeps growing. There are now nearly 500 AI unicorns, companies valued at $1 billion or more, many of them burning through cash with no clear path to profitability. So what does this mean for the everyday investor? Here's where we need to talk about the invisible threshold in your portfolio. If you have a 401k or an IRA invested in an S&P 500 index fund, which millions of Americans do, you probably think you own a diversified piece of the American economy. 500 companies across technology, healthcare, consumer goods, finance, energy. That's diversification, right? Not anymore. Not really. The reality is that a massive portion of your returns over the past few years has come from just a handful of companies. Names like Nvidia, Microsoft, Apple, Amazon, and Alphabet. These are the Magnificent Seven. though some of them have been more magnificent than others lately. Nvidia alone contributed nearly a third of the S&P 500's total return in the first half of last year. One company out of 500. This matters because when you look at your portfolio and see gains, you're not really seeing the broad American economy doing well. You're seeing a concentrated bet on AI infrastructure paying off. And concentrated bets, by definition, can go the other way just as dramatically. Here's a piece of financial history that I think about a lot. During the dot-com boom of the late 90s, telecommunications companies raised nearly $2 trillion to build over 80 million miles of fiber optic cable across the United States. They were building the infrastructure for the internet revolution, and they were certain that demand would follow. By 2005, as much as 85 to 95% of those cables remained completely unused. Dark fiber, they called it. Billions of dollars of infrastructure sitting underground doing nothing. Companies that were worth billions went bankrupt almost overnight. One telecom equipment maker saw its revenue fall from over $1.5 billion to $300 million practically overnight. Its stock dropped 98% from the peak. The parallels to today are uncomfortable. Major tech companies are spending hundreds of billions of dollars building AI data centers. The Stargate project alone, backed by OpenAI, SoftBank, and others, plans to spend $500 billion on a nationwide network of AI infrastructure. They're building for demand that might not materialize, or might materialize much more slowly than anyone expects. Now let me be clear. I'm not saying AI isn't real or important. The internet was real and important too. The companies that survived the dot-com crash, like Amazon and Google, went on to become some of the most valuable businesses in history. But here's the thing people forget. Amazon's stock dropped over 90% during the crash. 90%. If you had invested at the peak, you would have had to wait years, in some cases over a decade, just to break even. And most of the companies from that era didn't survive at all. So how should you think about this if you're trying to build real long-term wealth? First, we need to talk about the psychology at play here, because understanding your own brain is half the battle. There's a term in behavioral finance called FOMO, fear of missing out. Research shows that FOMO significantly influences investment decisions, particularly among younger investors. When you see headlines about AI stocks soaring, when your coworker mentions how much their portfolio is up, when every financial news outlet is talking about the AI revolution, something happens in your brain. You start to feel like you're being left behind. You start to wonder if you should buy more, if you should concentrate your bets even further. This combines with something called herd behavior. When we see others doing something, especially in uncertain situations, we have a deep evolutionary instinct to follow. If everyone is running in one direction, our ancestors survived by running too. They didn't stop to analyze whether there was actually a predator chasing them. In financial markets, this creates feedback loops. Prices rise because people are buying. People buy because prices are rising. Eventually, prices become completely detached from any fundamental value. And when the music stops, everyone rushes for the exits at the same time. The research on this is pretty clear. Studies show that herd behavior and FOMO together account for a huge portion of the volatility we see in markets. And here's the really interesting finding. The presence of FOMO amplifies the effect of herd behavior on investment decisions. It's like gasoline on a fire. Now here's where I want to shift the conversation from fear to opportunity, because understanding these dynamics doesn't mean you should panic. It means you should get strategic. Let's talk about what actually builds long-term wealth, because it's probably not what the headlines are telling you. The S&P 500 has returned an average of about 10% per year over the long term. That's a remarkable number. If you just stayed invested through crashes and booms and everything in between, you would have done incredibly well over any 30-year period in modern history. But here's the catch. In any given year, the actual return rarely looks anything like 10%. Sometimes it's up 30%. Sometimes it's down 40%. The average is just that, an average across decades of wild swings. The real key to capturing that long-term average is staying invested through the bad times. And the only way most people can do that psychologically is if they're not over-concentrated in whatever sector happens to be crashing. Think about it this way. If you had all your retirement money in tech stocks in 1999 and you were planning to retire in 2002, you would have watched your portfolio fall by 50, 60, 70% or more. That's not a setback. That's a retirement-changing event. You might have had to work another decade just to get back to where you started. Now imagine a different scenario. Same timeline, but your portfolio was diversified across large caps, small caps, international stocks, and some bonds. The tech crash still hurt, but it didn't destroy you. You could stay invested, keep contributing, and participate in the recovery. That's the difference between a market correction that stings and a financial catastrophe that derails your life. So what should the everyday investor actually do with all this information? First, know what you own. This sounds obvious, but most people have no idea how concentrated their portfolio actually is. If you have an S&P 500 index fund in your 401k, you effectively have almost 40% of your money in just 10 companies, most of them heavily tied to the AI boom. Log into your retirement account and actually look at what's in there. You might be surprised. Second, consider diversifying beyond the S&P 500. This doesn't mean abandoning it entirely, but it might mean adding some exposure to small cap stocks, international markets, or funds that use equal weight methodologies instead of market cap weighting. In an equal weight fund, every company gets roughly the same allocation instead of the biggest companies dominating. This naturally reduces concentration risk. Third, resist the urge to chase what's been working. I know this is hard. When AI stocks are soaring and everything else looks boring, it's tempting to pile more money into the hot sector. But the research is clear. The investments that have performed best over the past 15 years are often not the best performers over the next 15. Markets have a way of mean reverting over time. Fourth, think about your actual timeline and risk tolerance. If you're 25 and won't need this money for 40 years, you can probably ride out significant volatility. But if you're 55 and planning to retire in 10 years, extreme concentration in anything, including AI stocks, is a real gamble with your future security. Fifth, automate your contributions and resist the urge to tinker constantly. The data shows that investors who try to time the market, jumping in and out based on headlines and gut feelings, dramatically underperform those who just stay the course. The average investor earns returns well below market averages, precisely because they buy high when excitement is peaked and sell low when fear takes over. Let me tell you what happens to people who blow it at this stage, because I've seen it happen. The most common mistake is something called lifestyle creep meets recency bias. You see your portfolio climbing during a boom, and you start to extrapolate. You think, if my investments keep growing at this rate, I can afford that bigger house, that nicer car, that early retirement. You start making lifestyle decisions based on paper gains that haven't been locked in. Then the market corrects, and suddenly those paper gains evaporate. But the bigger house payment and the car loan don't. Another mistake is treating your portfolio gains as spending money. Your 401k hits a new high, and you start thinking about all the things you've been putting off. But that money isn't real until it's realized. And if you start tapping retirement accounts or taking on debt because you feel wealthy, you're setting yourself up for disaster. The third big mistake is doubling down at the wrong time. The hype is everywhere. Everyone's talking about AI, and you think, I should have more exposure to this. So you concentrate even further into tech stocks right as valuations are at their most stretched. This is classic bubble behavior. It's what people did with dot-com stocks in 1999, with housing in 2006, and it's what some people are doing with AI stocks right now. The antidote to all of this is boring. It's automating your savings. It's keeping your big fixed expenses, your housing, your car payments, at reasonable levels relative to your income. It's rebalancing periodically to prevent any single sector from dominating your portfolio. It's focusing on increasing your income over time rather than trying to get rich quick through investment returns. Here's the thing about major financial institutions warning about an AI bubble. They might be right, or they might be early, or they might be wrong. Nobody can predict with certainty when or if a correction will happen. But that uncertainty is exactly the point. Building wealth isn't about being right about any single market call. It's about building a financial life that can withstand uncertainty. 67% of American workers are living paycheck to paycheck right now. That number has actually been climbing, up from 63% just last year. Most people don't have the financial cushion to weather any kind of storm, let alone a significant market correction that might hit their retirement savings at the same time inflation is still squeezing their monthly budget. If you're watching this video, chances are you're trying to be smarter than that. You want to build something that lasts. You want to escape the paycheck-to-paycheck cycle and create real security. The path forward isn't through perfectly timing the AI boom or any other boom. It's through consistent habits applied over time. It's through understanding your actual exposure and making sure it aligns with your real timeline and risk tolerance. It's through resisting the psychological forces of FOMO and herd behavior that cause so many investors to buy high and sell low. Let me leave you with this thought. The AI revolution may very well be real. The companies building this technology may go on to generate trillions of dollars in value over the coming decades. But if history teaches us anything, it's that the path from here to there is never a straight line. There will be crashes, corrections, companies that fail, and timelines that take much longer than anyone expects. Your job as an investor isn't to predict exactly how that plays out. Your job is to build a portfolio and a financial life that can thrive regardless of which scenario unfolds. That means diversification. That means keeping fixed costs low. That means having emergency savings so you never have to sell investments at the worst possible time. That means playing the long game even when the short game looks so tempting. The bubble may pop tomorrow, or it may inflate for another 5 years before correcting. What matters is that when it does, you're not the person who concentrated everything into the hot sector, extrapolated unrealistic returns, and made irreversible life decisions based on gains that turned out to be temporary. You have more control over your financial future than you think, but only if you exercise that control through preparation and patience, rather than prediction and speculation. I'd love to hear from you in the comments. What's one money decision you would make differently if you could go back? Are you worried about your portfolio's concentration in tech and AI stocks? Drop a comment below and let me know where you're watching from. And if this video helped you see your money differently, please hit that like button and subscribe to the channel. It makes a real difference in helping this content reach more people who need to hear it. Thanks for watching. I'll see you in the next one.